Welcome, Sacramento. Welcome to the beautiful Sacramento State Alumni Center on this very beautiful afternoon. I'm Sanjay Varshney, your host. On behalf of Sacramento State, as Dean of the College of Business and the Chief Economist for the Sacramento Business Review, it is my pleasure to welcome you all to the very best forecast event in town. I know you like us, or you like the bad news. I don't know which one it is, right? Since you came back again this year to listen to what we have to say. So let me ask you, how do you feel today? Good? Good, very good. More optimistic than last year, right? So I think the presenters today have news that will certainly get your attention. Let me begin with a very special welcome with all our guests here. Our Provost, Dr. Joe Sheely for Sacramento State. Dr. Mike Lee, Vice President for Administration. We're very honored to have our distinguished guests with us. Also, the CFA Society of Sacramento and friends and supporters of Sacramento State. As you can see in this room, we are the University of Sacramento for the region. How many of you have some association with Sac State? You graduated from here, right? So as you can clearly see that we have a very strong and very powerful presence in the community. This is the 4th year of our work on the Sacramento Business Review. For the last 4 years, our experts have forecasted the region's financial health for you, and they have done a very good job. They have not just been right, they have been near perfect in their predictions. The 2012 market forecast is a joint venture between the College of Business at Sac State and the CFA Society of Sacramento. As you probably know, the CFA is the gold standard on Wall Street, and the PhD is the gold standard for academia. You combine the two, and we get the most comprehensive, intellectually sophisticated, and accurate analysis with the very best forecast in the region. This past year, we predicted that the regional economy would stabilize, employment would improve, housing and real estate would continue to drift in search of a bottom, bank credit would remain tight, small businesses would remain concerned about the economic outlook, and that all of these factors together would set the stage for a very slow recovery. We really stuck our necks out last year and made the bold prediction that the recession in Sacramento ended in 2010, and that 2011 would really not feel like the year of recovery. Ladies and gentlemen, I'm pleased to report we were right. Our new Sacramento Business Review Financial Conditions Index shows that the regional economy did bottom out in the first quarter of 2011. You're supposed to clap at this point. The Sacramento Business Review is now the most widely followed forecast in Sacramento. It has become famous, and based on the number of presentations we make every year, the number of hits we get on our website, and the coverage in the media, I'm proud to have a team that has produced a product that is the most respected. As usual, you can go and get the detailed forecast as well as the past copies of the forecast from www.sacbusinessreview.com. And as you can see, like I said, you can go back and see what we were saying 3 years ago, what we were saying 2 years ago, and you're going to find that we have been very right. Today, also, we're going to have hard copies that will be made available to you right after the event. Also, the agenda you have in your hands has the headlines for each economic report that will be presented. To help digest the forecast better, we have a hosted bar at the end and refreshments, okay? And this year, hopefully, you'll enjoy the beer and the wine much better. The 2011 market forecast is brought to you by Wells Fargo, SMUD, CBRE Incorporated, the CFA Society of Sacramento, and the Institute for Business Research and Consulting at the College of Business at Sacramento State. Ladies and gentlemen, each Christmas and summer, our 10 analysts work very hard, and spend their personal and vacation time producing the forecast and the reports. I want you to know that they don't get paid for this, and they do this purely as a public service to the region. But we do have print and other event expenses, and without the help of our financial sponsors, we would not be able to bring this publication to you. So thank you, SMUD, Wells Fargo, CBRE Incorporated, CFA Society of Sacramento, and Sacramento State. I would also like to take a quick minute to thank the CFA Society of Sacramento annual sponsors. Instinet is the platinum sponsor, JP Morgan, Jones Trading, ITG, and Bank of America Merrill Lynch as gold sponsors. And the bronze sponsors are Credit Suisse, Hong Kong and Shanghai Banking Corporation, Morgan Stanley, LP Capital Advisors, and Deutsche Bank. Before we make our presentations on the regional economy, we are very fortunate today to attract a very well-known, nationally well-known figure as a keynote speaker who will provide us with his forecasts on the global and the national economy. To introduce him, I invite Jonathan Lederer, President of Lederer Private Wealth Management, to the podium.
I promise that the fact that we don't get paid and that we work during Christmas has had nothing to do with the fact our forecasts have been negative over the past several years, I swear. I'm also the vice president of the CFA Society of Sacramento, and on behalf of our 180 members, I'd like to welcome you all to the forecast event today. And for those of you who aren't overly familiar with the CFA Institute or the CFA designation, I thought I'd give you a little bit of information about that. Since it was first introduced in 1963, the Chartered Financial Analyst designation, or CFA charter, has become the most respected and recognized investment credential in the world. I think it was Jason Zweig, in fact, I know it was Jason Zweig, Wall Street Journal reporter, who said it best. He said, quote, "The CFA designation is the gold standard of intellectual rigor and ethical conduct in security analysis." I thought that hit the nail on the head. The CFA program's a globally recognized graduate-level curriculum that provides recipients with a strong foundation of the real-world investment analysis and portfolio management skills and practical knowledge needed in today's investment industry. It also emphasizes the highest ethical and professional standards. The program is organized into 3 levels, each culminating in a 6-hour exam. CFA program candidates report dedicating in excess of 300 hours of study per level. And if there are any spouses of CFA charter holders, you might argue that that number is understated. But anyway, yeah, it's a lot of work that goes into it. Completing the entire program is a significant challenge that takes most candidates between 2 and 5 years. There are currently more than 100,000 members, CFA members, working in over 135 countries around the world. And it's because of this global reach that the CFA Institute has that I actually had the good fortune of listening to our keynote speaker today last May in Edinburgh, Scotland at the CFA annual conference. And again, the CFA has conferences around the world given its global reach. Our keynote speaker, Axel Merck, was there and delivered a great presentation, and we're very happy to have him here today. A little bit of background. He is the president and chief investment officer of Merck Investments, which is a manager of the Merck funds. He's an expert on macro trends, hard money, international investing, and on building sustainable wealth. An authority on currencies, he's a pioneer in the use of strategic currency investing to seek diversification. He's a sought-after speaker and author on topics ranging from the economy, gold, and currencies to sustainable wealth and personal finance. And he's also a regular guest and contributor to the business media. For those of you who watch CNBC, Bloomberg Television, Fox Business on a regular basis, you've no doubt seen him. In fact, for those junkies who watch those Yahoo Tech Ticker videos, he was on this morning talking about Fed policy and the dollar. He founded Merck Investments in Switzerland in 1994, and in 2001, he relocated the business to California. And in 2005, Merck Investments launched its first mutual fund, the Merck Hard Currency Fund. He holds a BA in economics, magna cum laude, and an MSc in computer science from Brown University. He's married to Hannah Tikkanen Merck, and they live in the San Francisco Bay Area with their 4 children. He's a marathon runner, and he's a private pilot. In fact, he flew here today. Let's give a warm Sacramento welcome to Axel Merck.
Thank you, John, for that very kind introduction. And I'll walk around with the lapel mic. I hope you hear me. Coming to Sacramento, I'm given 20 minutes to a very diverse crowd, so I promise I'll make as many politically controversial comments as possible to keep you folks interested. And it's very timely, as anybody who followed the press conference of the Federal Reserve Chairman Ben Bernanke today knows that there are a lot of political sensitivities around in managing the economy. Now, our focus, as John alluded to, is the global world. We focus on currencies, and anybody who's been listening to the news, well, they know something is up with the euro or the dollar or the Chinese renminbi or whatever it may be. And so I'll give you a very quick run through to how I think the world is working, what's driving the world, and with that I hope I give you a little bit idea of where we may be heading to, and you may be able to take one other thing also down for the local economy. And for me, local might be US economy, but even Sacramento or California. In a nutshell, we have a mess in the world. And in the US, we don't know whether QE3 is going to come or not. In the Eurozone, we don't know whether we should be euphoric or be in a panic. In Asia, we don't know whether we have a housing bust or whether we have this avalanche of a consumer boom, and the entire world is afraid of a contagion. And so what do you do in this sort of world? And well, everybody does something different. And in particular, everybody does what they think is in their interest. And on that slide there, I have what is in their perceived self-interest. And it's perceived because what people think is in their interest may not necessarily be in their interest. If we're going to introduce trade barriers to China, well, you're only shooting yourself in the foot, because all those jobs that had adjusted to the new world, they're the ones who are going to be punished then. And so similarly, of course, the same thing applies to anybody else. The Chinese are trying to do the right thing by micromanaging the economy, but you have a whole set of unintended consequences. Think of Brazil introducing currency controls. They're the ones that coined the term currency wars. Well, guess what? We had this bout of an economic slowdown in the fall, and everybody was fleeing out of the Brazilian real. And so anybody who's fighting change is at some point hurt. More importantly, everybody is fighting change. And let me give you a little bit of background of how we got here. Over the past 25 years or so, we have been moving the US economy towards a more credit-driven society. We allow consumers to spend more by giving them access to credit. And we think we do everybody a favor by giving them credit cards, by giving them loans. At the same time, we had Asia trying to enter the world stage, subsidizing their exports, amongst others, by keeping their currencies competitive and cheap. And so you have this combination where Asia is trying to grow at any cost, the US is trying to grow at any cost, low taxes, keep the economy rolling. Well, what happens when you do that? You produce a lot of gadgets, a lot of goods. The prices in these goods, if you produce so many, is going to be very low because you have an overproduction of goods. But commodity prices are going to be very high because something has to give. And so what happens is that if you're corporate America, you are kind of squeezed in the middle. Here we go. If you're corporate America, you have no pricing power. Your consumers have too much debt. There's a flood of imports coming in from Asia, and then you're faced with high commodity prices. And so what do you do if you're a corporate CEO? Well, you ship jobs overseas because that is how you maintain your margins. And so these policies, and I mentioned to you, I'd like to be controversial here, these policies that are trying to do the best are actually contributing to this offshoring that we have. And not that this globalization wouldn't have happened anyway, but we're accelerating it with the sort of policies that we've had. Now, if you put yourself in the shoes of the typical consumer, well, you lose your job because you're just being outsourced. But you have so much debt, so you're going to get another job. If you find one, if you don't find one, you start your own business. 9 of these 10 new businesses are going to fail, but the 10th one might be the new Google. The beauty about the US economy is that it's flexible and adjusts. The pain is it's been happening at a very rapid pace. And because there is this flood of new workers coming to the market because of this outsourcing, well, the wage pressure hasn't really been there. So if you add all of this together, you have to work harder and harder. Real wages aren't going anywhere. You're going to be dissatisfied. So on the left, you have the Occupy Wall Street movement. On the right, you have the Tea Party movement. And we're very fortunate here, because in the rest of the world, they have revolutions. We sometimes cynically say that, in Egypt, the next president better be a very good chef. Because the one thing, you can oppress your people for decades, but if you don't feed them, if the cost of living goes up too much, and the food prices, here we just complain about it, but we don't need to eat or drive, so higher food and energy prices don't matter to us as much. But in Asia and in the Middle East, it matters a great deal. So in Egypt, you have a major problem, because what's the new government going to do when you're still not going to be able to feed your people? Or think Libya. In Libya, petrol prices, fuel prices subsidized by 90% under Gaddafi. Well, the new government simply won't have the money. So that's going to make for a very unstable government. And the reason I say that is because what that means is that if you are a policymaker, you have a bigger chance of being elected if you're going to be more populist, if your political message can be distilled into a tweet. And we see a lot of that happening both on the left and on the right. And if you think about what that means for our major issues that we're facing on the fiscal side, well, how do you think we're going to come to an agreement? This gridlock we have in Congress, be it nationally or locally, is going to persist. Now, there might be some differences in how we vote and so forth, but the main challenges we have are going to be ever more difficult to resolve. So what does that mean? Well, that means we'll call up Ben, we'll call up the printing press and say, hey, how about we print our way out of these problems? Normally, we pay our workers what we promise them, but the purchasing power of that is eroding. Think about it. The one thing that Democrats and Republicans agree on is to change the definition of the CPI and how pensioners are being compensated. That's exactly the sort of result you're getting from the pressures that have been building up. More importantly, though, this consumer credit that I mentioned in the beginning, we've been driving the society towards a credit-driven society. That means that yes, our money takes us further, but as a result of the housing boom, everybody started to use their houses as piggy banks. When that blew up, everybody decided to downsize. Well, if you're policymakers, you don't like that, especially you don't want to promote it. You don't want to promote, hey, let's downsize, because that's the natural thing that has to happen, because downsizing means foreclosures and bankruptcies. And so what policymakers have been doing is they've been throwing a lot of money at that problem on the fiscal and on the monetary side to try to stem that. Because if you think about it, the biggest problem we have in the US economy is that millions of homeowners are underwater in the mortgage. Ben Bernanke today said about $800 billion in total we have underwater in mortgages in the US. There are three ways to fix that. You can fix it through downsizing. That's political suicide if you promote it. You can fix it by paying off your debt. Individually, that might happen, but when real wages don't go anywhere, that's difficult. Or thirdly, you can do it by pushing up the price level. And so that is the quote-unquote solution. Now, no Fed official is going to say that that's exactly what we want to do. But think about what's been happening at the Federal Reserve. We've printed all this money, and then since last summer, we've introduced more communication strategy. Well, what communication strategy is not about the one fellow that's communicating is the new head of the European Central Bank. He just says, this is how it works, and this is what we do, period. Well, what we do in the US is different. What we say is, this is how the market should behave. This is how short-term interest rates should be. Look, this is how we're forecasting long-term interest rates. And the goal is that hopefully the market will take the Fed seriously and will act accordingly. In the meantime, let's print as much money as possible, but let's not have these inflationary pressures pop up anywhere. So it is much more an expectations management. That's also, today was the announcement of an inflation target. So let's print all this money, but we have a target here, and as long as the market behaves, that's fine. Ultimately, inflation is not a factor, in our view, of the slack of the economy. In the 1970s, you saw that you had high unemployment and high inflation. And in the Federal Reserve, there are two camps. One says that is the main factor. One says, no, it's something else. Inflation will happen if people believe there will be inflation. And that might sound like a circular argument, but think about it that way. You live in a country where there's high inflation, you'll do anything in your power to try to get a higher salary, to try to pass on higher prices. And so it's this containment of inflation expectations, and that ultimately is a result of the confidence in the central bank, in the Federal Reserve. So I promise not to be more complex than this. So I'll try to keep it a little simpler here and show you the world we're in right now and try to kind of distill it. 2 weeks ago, the World Bank came out and said, hope for the best, but plan for the worst. And obviously, the goal was here to get the people the attention, look at what's happening in Europe. And in Europe, I'll talk about that in a minute, many scenarios are possible, but you should hope for the best and plan for the worst. Well, the result of that you saw again today with the Federal Reserve action. You also see it in Bank of England. You see it in the Bank of Japan. You see it with Chinese policymakers, which means let's keep the easy money as freely available as possible. It's kind of a signal, hey, you just don't know what's going to happen. In order to contain this contagion, we have to keep these printing presses up and running. Well, I promise not too much technical, but this is a chart with wonderful lines. What this is a chart of the growth of balance sheet of the respective central banks. And basically, it's a crude measure for the amount of money that's being printed in different parts of the world. Now, any economist out there, they'll have some issues with some of these, and offline I'll be glad to argue those. But it's just a rough idea. The Federal Reserve is the king in printing money. We're just better at printing money than others are. The US dollar has gone down the last couple of years, the last 10 years, 30 years, 100 years. We're just better at it than others are. Bank of England, same sort of story. Look at the bottom of that. In the very bottom is the Bank of Australia. They have been tightening monetary policy. They have been mopping up, getting rid of money. It's very easy for them to do because they ship all these commodities over to China, and so they need to dampen their economy. Japan never noticed that there was a crisis. That's the flat line at the very bottom. They did all the money printing in the 90s already, so they didn't have to do any more. The one line you probably can't see so much is the European Central Bank. That's towards the bottom. The very reason the Europeans have all these problems is because they didn't print all this money. They are on the other side of what we call is the Bernanke trade. Bernanke has testified in Congress that going off the gold standard has helped the US recover faster from the Great Depression than other countries. So if I debase your purchasing power, you're going to get more normal economic growth. You're going to feel better. Not good if you're a saver, and he kind of indicated that again today. Well, somebody has to be on the other side of that trade. If you try to do the right thing, don't print all this money, you're going to have a host of problems, but you might have a stronger currency. And I indicated our field is currencies. And by the way, one of my colleagues is going to hand out a little sign-up sheet if you're interested in a newsletter to go more into depth into any of these things. But talking about the kind of the interaction that's going to happen here. In Europe, as of November 1st, we have a new president of the European Central Bank, and many of you have heard that there are these unlimited financing facilities. 3-year terms. You can get as much money as you want to. 500 billion euros or so have been made available. In the US, with quantitative easing, the Federal Reserve buys securities and in return gives cash to the economy. The more the money is printed by the Fed, the bigger the earnings of the Fed. Over 70 billion were given to the Treasury. It's very easy because when you print money, you buy a security, and it's a debt security, you get the interest. So the more money you print, the higher your income. Of course, it doesn't cost the taxpayer any money, but you're eroding the purchasing power. Now, Draghi, the new ECB president, did something else. He said, I'm not going to buy these securities. You're just going to park those securities with us, and for 1%, I'm going to give you cash. They are, quote unquote, splitting the coupon. Rather than the ECB pocketing all this gain, they're shoving all this money into the banking system, and then the banks can buy anything with it. They can buy sovereign securities with it, other securities. So it's kind of a quantitative easing on steroids in some ways, because you need to prop up that banking system in Europe. And so recently the ECB has been printing some more money, and the euro has come down a little bit. Here we go. Very quickly, in a nutshell, what's happening in Europe. I already mentioned the reason they have these problems is because they're trying to do the right thing. Well, without going into too much detail, the one message to take from Europe, or a couple of messages. One is, this is not a European crisis. This is just the next phase in the financial crisis. We have a global financial crisis. The difference is that in Europe, the bond market is telling policymakers to get their act together. We are arguing that the language of the bond market is the only language policymakers are listening to. In the US, the bond market is behaving, and guess what? We're not engaging in any decent fiscal reform to be fiscally sustainable in the long term. Nobody knows exactly when that's going to change, but there's a difference between Europe and the US. In the US, we have a current account deficit. That means we need foreigners to finance all the debt that we're issuing. So if we don't have economic growth, or if we have the bond market misbehaving, the dollar could be under severe pressure. In Europe, the current account is roughly in balance, and as a result, even with the bond market misbehaving, well, it's not the end for the euro. look at the other extreme to illustrate that further. In Japan, they have historically financed their deficits domestically. Indeed, the more dysfunctional the Japanese economy is, the less money is being printed, the stronger the yen appears to be. And that's how in Japan, when the earthquake hit, the yen went up, whereas in New Zealand, where there's a current account deficit, when the earthquake hit, the New Zealand dollar went down. In Europe, one more point. I do this very quickly because we only have a few minutes, and then we open up for Q&A. People talk about this fiscal compact. We'll come to an agreement on how to govern Europe. Well, there is no crystal ball. It's a process. It's a very ugly process, fairly dysfunctional. The bond market is giving the pressure. And if there's one negative about this great funding facility by the European Central Bank, it takes away some of the pressure, because the moment the pressure is gone, policymakers are losing all the interest in all the promises they have made. But at the same time, this fiscal compact, this state we want to be in, is something that's really nothing new. We are already there in some ways. And specifically, any weak country in Europe that needs help raises a white flag, then the IMF comes in, the partners in the Eurozone come in, and in return for giving up sovereign control over your budgeting process, you're going to get help. This fiscal compact they're talking about in Europe is exactly the same thing. Once you give up sovereign control over your budgeting, and in return you're going to get some easy money. Germany is the country with a pocketbook, but once you write the check, you know that in Sacramento very well, you don't know what's going to happen with the money anymore. So you want to set the rules before you write the check. And that's exactly what's playing out there. We're moving, and the one thing we can gain in Europe is that there's clarity on the process. If there's one thing that's worse than bad news, is to have no news, to have uncertainty how things are going to evolve. So crises are always going to happen, but you need to have sound institutional processes in place in order to manage those crises. In the US, when we had stress tests, it was very unpopular, but we stuffed money into the banking system. While in Europe, they had a stress test, very valuable, so that the market could then target the individual banks and force them to raise money. Problem is, there wasn't any money available. So when you do these stress tests, it's good to actually have a plan to move forward with that. Quickly, euro is not euro. We sometimes say that we prefer holding a German T-bill over a US money market fund, because US money market funds used to have dramatic exposure to commercial paper issued by European financial institutions. Some mutual funds over 75%. That has come down substantially, but in recent weeks there has been a slight uptick again. But European paper is not the world all over the same. Greece is pretty hopeless. Germany is extremely popular, the German debt. But I don't know how well you can see these things. In Ireland, for example, and these charts are the bond yields of these respective countries, the cost of borrowing for Ireland has come down. So it is possible to regain market confidence. In Italy, it's kind of difficult because they have a technocrat and prime minister. In Spain, they now have a government with an absolute majority. So in theory, it is possible for them to implement reform. But at the same time, this pressure from the bond market is very much necessary to keep things moving. Very quickly, what's happening in the world in different regions. In the US, just like anywhere, we are worried about contagion fears. We have a very dovish Fed. Lacker, the fellow who dissented today, is voting again this year. He didn't vote last year. He's the only hawk on the Federal Reserve Board. All the dissenters we had last year, they're not voting this year. The Federal Reserve is artificially trying to talk down the yield curve, and so that you can boost the economy without raising inflation expectations. In Europe, we're going to have this back and forth between euphoria and panic. The glass is half full, the glass is half empty. Now, what we think will happen is the euro is not going to disintegrate in this environment, but there may be better opportunities elsewhere, because the rest of the world is going to be printing money. The money is not going to flow to your local business in Sacramento. No, the money is going to flow to where the monetary sensitivity is the greatest. That means precious metals, the Australian dollar, New Zealand dollar. So we'll finance the rest of the world yet again with the sort of policies that we are pursuing. Now in Asia, 2 words on that maybe. China, there's, on the one hand, this talk about a housing bust. On the other hand, there's this talk about this consumer avalanche. Well, yes, there is a housing boom, there is a housing bubble, and likely a housing bust. The difference between the housing bubble in China and the one we had in the US or the one we had in Spain is that the Chinese really have nothing else with the money to do than to buy houses. They're restricted from investing abroad. They put a little bit of money in the stock market. They buy some precious metals. The average high net worth individual in China owns 3.3 housing units, apartments or homes. Most of them are empty. Now, of course, that means there's a bubble, and of course it means prices could come down. But as far as the impact it has on the economy, it might not be much worse than the impact a stock market plunge might have. So if the market goes down 20%, yes, it hurts. It might hurt consumer confidence, but not to the same extent as a real housing crash has. The problem with housing busts throughout the world typically is the amount of leverage. About 15–16% of consumers are only taking out loans from banks, and about the same amount then take out loans from relatives, far less than in other countries. What will happen is that, and what happens in China is that the official numbers you can't really trust, because the government is trying to micromanage the economy, and on the other hand, there's plenty of black market, and not everybody declares what they buy, luxury goods and so forth, and that's good news. The reason that's good news is because otherwise you have a Soviet Union-style economy. There you had a totalitarian regime that worked, which means you have a shortage of goods and services. And so it's nice that they have this multi-dimensional economy. But the problem with that is it's very difficult to contain inflationary pressures. The way you contain inflationary pressures in that environment is through currency appreciation. By allowing your currency to appreciate, you do that better. If you think about what country can afford to have a stronger currency, it's a country that produces more value-added goods and services. That's when you have pricing power. You have more pricing power with a BMW and a Porsche than you have when you export sneakers from Vietnam. Indeed, Vietnam has engaged in competitive devaluation because they're desperate in the absence of a strong US recovery. And in China, they are now producing iPads and the like. That's when you have pricing power. And indeed, what that means, of course, for us is that over time, if you talk to the CEO of Walmart and the like, well, we will face higher prices. So all the stuff we don't need and buy from Walmart is going to get more expensive. Historically, we haven't seen inflation in the numbers that our officials tell us, because it mostly measures the stuff we import from Asia, whereas anything that we cannot import, the cost of healthcare, education, local craftsmanship, has been going up. China has a leadership transitions. 7 of the 9 Politburo members are being replaced this summer. We published a white paper if somebody wants to go into depth about the profiles of these candidates, available on our website. The short of it is, though, there is going to be a lot of continuity. And one of the upcoming leaders is going to visit the administration in a few weeks, so we'll get to know them more. No major changes. Social stability is the most important thing. And whenever you think about politicians anywhere in the world, all politics is local. So the Chinese are not going to do what Congress tells them to do. They're going to do what they think is in their best interest. If you put their thinking cap on, it's going to be much easier for you to realize which direction they're heading in. The challenge we have in this world is that we have an extremely activist government. This is not about the current administration in Washington. This is about administrations everywhere in the world. We have, and it is not just on the fiscal side, it's on the monetary side as well. We're spending and printing billions and trillions. Now, the reason that is a problem is because rather than putting your capital based on fundamentals, you're putting your capital in a local Sacramento company because it's so great, a company with such good management, you're going to put your money where you think the next bailout is going to be, where you think that the next fiscal or monetary stimulus is going to be. That has to lead to capital misallocation. That has to lead to the so-called unintended consequences. I just mentioned, hey, gold is doing well. Well, that's an unintended consequence of these sort of policies that we have. And so it is, policymakers are frustrating that their things are not working, but ultimately it's a result of many years of cumulative policies that is now telling them, oh, we can't have things happen. We can't have housing prices to come down. And by the way, if somebody can't afford their home, well, the best thing that can happen to them is to downsize to a home that they can afford, because then they can build up disposable income again to, down the road, maybe afford a bigger home. Whereas if they're stuck in the home they can't afford, well, then they can't even have put money aside to fix the roof. But as a politician, you cannot promote that because all the bad things that have happened. And so you're trying to somehow subsidize them to stay in their homes. Very briefly, before I wrap it up, investor concerns. Although inflation is low, based on our surveys, inflation is a major concern. Downside protection of assets is a major concern. And correlation of assets is a major concern. When policymakers have such an active role, everything moves in tandem. When you guarantee everything, when you have bailouts, well, what happens? Everything is safe until nothing is safe, because then the guarantor suddenly is not safe anymore. And that is why everything is moving in tandem these days. I talked about the world, and I'm going to open it up here for Q&A in a second. Equities, just to put that in there as well. If we print enough money, equities will do just fine. But unfortunately, at this stage, we're not investing based on fundamentals, as I indicated. Fixed income, the long end of the yield curve The long bond, we are very concerned about it, and not because we think somehow foreigners are going to drop buying the US dollar, but because the volatility is so low. Everybody is chasing for yield, is hungry for that. And so when that happens, those are momentum players. Those are not the sturdy hands you want to have in that market. And so when that money goes out, it will be a rude awakening. I hear there are lots of culpus folks in the audience, so also for pension funds, that's going to be very, very rough. With that, I'll pass it back on to manage a Q&A for a few seconds. Please read that disclosure. And again, if you have any interest in going in more depth, feel free to sign up for our newsletter. So
we are going to have questions and answers at the end of the whole session, but right now we do have time for maybe a couple of questions, if there are any.
I know that, as you said, the political minds, the people that are running the country can't promote downsizing of the housing market. But it appears that in actions, they are actually promoting it from behind the scene, whereas now bailing from your house and getting a short sale is a lot easier, at least in this region, than it ever has been. And people more and more are talking to each other as neighbors, and more they're listing their houses in the short sale market.
Of course, yes. People, of course, have the option handing over the key to the bank and saying, hey, good luck. The flushing out of the system, as brutal as it is, gets you through, allows you to move on with it faster. Now, these market trends are not really stoppable, but policymakers can slow them down. And from a social point of view, maybe that's what policymakers decide. And of course, it's in their right. They are elected officials. They can do that. And there are different views on what is appropriate and what is not appropriate. The challenge we have with these policies is that when you throw so much money at the system, right now we're getting away with anything because the money doesn't stick. But what happens if all this money we throw at the system is suddenly working and we have a major boom? Bernanke says, hey, I can raise rates in 15 minutes. But think about what happened in the early 80s when Volcker raised rates. He raised them to 20% to get rid of this evil inflation. Nowadays, we can't do it because we have so much leverage in the economy. So it makes for great textbook speech. But in practice, you just can't do it because as soon as you raise rates a little bit, you're going to crush right back down. And Bernanke knows that because he has said that one of the biggest mistakes in the Great Depression was to raise rates too early. And so that means to us, well, you rather want to be prudent and take it slow rather than throwing all this money at there. But ultimately, it's a policy decision. And I'm not the one deciding on the policies, but I can invest my money in the Australian dollar while here we're printing our money and trying to debase the currency locally.
One other question?
Can you speak to your short and long-term views on emerging market currencies?
Sure. Short-term and long-term views on emerging market currencies. I didn't touch much other than China maybe on that. A couple of things. The key difference between emerging markets and the major economies is that we have free-floating currencies in the major currencies. And a lot of people say, oh, the emerging markets, that's the future. And we agree, there's a lot of value to be had there. But those are tightly managed currencies. So what you do when you buy those countries, you're buying the political risk. You're buying the political risk that something has to happen, that they have to come to the senses, embrace stronger currencies because it's good for them. And again, they do what's in their own interest. Vietnam debasing, the more advanced an economy is, the more they will embrace that. Exceptions are there. Brazil doesn't know any better in trying to fight the wars of the 1970s. But Australia is very firmly open to that. They're not an emerging market. But Singapore, very prudent, for example. So the more the advanced the economy is, the more prudent they are in managing those sort of things. The other thing to keep in mind when you enter those markets are small. One of the reasons the US dollar is the reserve currency is because there's so many dollars around. There's liquidity. If you're an international investor, you can take your money in, you can take it out. In many of these emerging markets, there are only very few securities you can buy, and when the money goes in, everybody dives into the same security. So it will take many years before those things are really available and far more flexible for investors to go to on a large scale.
Very good. Thank you, Axel.
Right. Thank you.
Axel, Mark. Thank you, Axel. Thank you very much for your insights, for your comments. Certainly, thank you for flying up from the Bay Area and giving us your presentation, even though we gave you only 20 minutes. And we won't ask you what your marginal tax rate is. And certainly, I'm not sure where you got the idea that Sacramento is a controversial political town. We're just dysfunctional. At this point, I would like to invite all the Sacramento Business Review panelists to come up so we can start the regional economic outlook. As they're coming up, so as the wise saying goes, since most of us are financial experts, we can pick on economists a little bit. Economic forecasting is like trying to drive a car blindfolded and following directions given by a person who's looking out of the back window. Sounds crazy, right? Well, the good news is we do a very good job at it. So the first paper, the first economic report, is on the labor market, the regional economic outlook on the macroeconomic conditions. And it is a report written by two experts, Brian Liu and Yang Sun. I'm going to start with Brian Liu, who holds the CFA designation. He's an investment officer at CalPERS and a member of the team responsible for trading the global internal equity and futures portfolio. Prior to joining CalPERS, he worked at Roseville-based DCA Partners, supporting the firm's investment banking business and private equity investments. Previously, Mr. Liu was a member of the equity research team at Deutsche Bank Securities and an investment analyst at a long-short hedge fund in New York City. Mr. Liu earned his MBA from the NYU Stern School of Business and an economics degree from Duke University, and also holds the Chartered Financial Analyst and CAIA designations. Yang Sun, PhD, is an assistant professor in the College of Business at Sacramento State. In addition to his PhD in industrial engineering from Arizona State University, he has a Six Sigma black belt. He also received an engineering degree from Tsinghua University in China. He has research interests in the areas of supply chain management, global operations strategy, lean and Six Sigma, technology management, managerial economics, operations research, applied statistics, and as a recipient of the Dean's Research Award and the university's Outstanding Scholarly and Creative Activities Award. Ladies and gentlemen, for the first economic report, please welcome Brian Liu.
Afternoon, everyone. If you've been following us for the past 3 years, you know those drinks are definitely necessary after our speech. But I promise you, I think this one hopefully will be a little bit less discouraging. And I'll start off my economic overview with this little cartoon. It's the first law of holes. If you're in one, stop digging. And I think this is actually a pretty good analogy of where we are here in Sacramento, because I think very few of you will disagree that Sacramento here as a region, we're in a little bit of a hole, especially if you compare where we are today with even just a few years ago. But the question we've been asking constantly and consistently over the last 3 years is really, has the region stopped digging, at least? On one hand, as Sanjay mentioned, the local recession officially, if you look at GDP, ended in 2010. But I guess I would argue that for most of us in 2011, it didn't feel like the recession was over. It didn't feel very much like a strong recovery. For most of 2011, Sacramento still had a net job loss. The labor force was still shrinking as discouraged workers just leave the workforce. Housing prices were still dropping. Consumer confidence was generally weak. And back in the fall, some economists were even predicting another U.S. recession, given everything that was going on in Europe. But I think finally, we're at a point where we can answer this question: has Sacramento stopped digging? Well, we cautiously say this year, yes. And here are a few of our projections for 2012. Spending and job growth, we believe, will be positive this year. That's both consumer and business spending. The regional unemployment rate will still be high, but we believe it's going to drop to the 10 to 11.5% range. The backlog of distressed properties will still weigh on the housing market, but fundamentals are definitely improving. All that said, like Axel, very poignantly noted, uncertainty is probably going to be the word for 2012. Certainly the first half, and it's going to continue to have a depressing effect on spending and investments. If we look at the labor market first specifically, what you can see here with this chart is the black line represents the local unemployment rate, and that has dropped to 10.9% in December. That's down from a peak of 13%, and we expect that to stay in the 10 and 11.5% range in 2012. But the data point that really has turned us much more optimistic is that solid green portion that you see there, and that's the 12-month moving average of monthly job change, which, as you can see, for the first time in nearly 5 years, has actually turned positive. Basically, what that's saying is, if you look at the last 12 months, on average, we've actually added jobs to this economy, which is certainly a very good sign that job growth going forward is going to be relatively sustainable. And we believe that's actually a better measure of the health of the job market than the fickle, sometimes, unemployment rate. So besides unemployment, there's a host of other drivers, of course, that help drive economic growth that I've listed here, both positive and negative. And if you look very closely, you'll see that the list on the left has exactly 3 more bullet points than the list on the right. So what does this mean? Well, it doesn't mean anything. It just means I picked 3 more bullet points, but certainly makes us feel better. But what we will say is really what we've seen this year is a lot more positive factors, a lot more things to hang our hat on that really show that the growth recovery that we've been seeing is certainly sustainable. On the negative side, what you can still see, we're still going to have a high unemployment rate. That is going to take some time to work down. The housing market, as you know, here in Sacramento, has been a pain point for sure. We see that continuing. State and local budgets are certainly tight. That's going to continue to be a pressure. Households still have a lot of debt, well over 100% on average over income. The euro area crisis spillover is a huge concern. It's going to lend a lot of uncertainty in the first half of the year especially. And then just this really uncertainty about the direction of U.S. policy, as we've been through with some of the stalemates in Washington. On the positive side, you can read a lot of those factors. 2 points that I want to specifically call out are the last 2 there. The negative wealth effect is waning. Certainly people's homes are worth less. Stock market crash has depressed values, but people know that, and I think the initial hit that we've seen on spending because of that is starting to wane. It's still there, but it's starting to get better. And then the last point, that we do believe there is some pent-up demand for consumer durables in particular, such as autos and household creation. And just to dig into that last point a little better, we're certainly a real estate kind of driven market here in Sacramento. This chart shows the pace of U.S. housing starts, which is that black line. Again, this is the whole nation, but you can certainly draw conclusions back to Sacramento. And then that solid gray line is the run rate of the demographic demand for homes. So that's household creation plus homes that are destroyed as well, replacement. And when you can see there, what I've highlighted, circled there in red, is over the last few years, we've been running probably about half the rate that demographics would dictate for homes. Now, granted, we have a lot of inventory, we have a lot of shadow inventory, and that needs to be worked through. But eventually, you would think that these 2 lines need to eventually converge, even here in Sacramento. It may take some time, but eventually that should be a win at our tails. Now, all that said, we're certainly more optimistic, but let's just not forget, it's still a very, very big hole. Household debt to income is still extremely high. Household income, if you take out government transfer, is actually not growing. The backlog of distressed properties is significant, especially for Sacramento, as we know. Unemployment rate's still elevated. What we've been saying for a few years now is that we, especially here in Sacramento, believe that there's a large overhang of discouraged workers who have actually left the workforce. When the economy actually improves, what we would expect is actually those workers to come back, which is why you may not see the unemployment rate actually improve, even though new jobs are being created. Structural factors will still make it hard for that unemployment rate to come down. Skill loss, we've lost a lot of construction jobs in this area as well. So there may be a skill mismatch for what the jobs are being created. And all in all, we've published this in the past, but if you look at the number of jobs that we've lost over the past few years, it could take up to 7 to 10 years for us to recover those lost jobs. And then finally, I'll just close with these 2 thoughts. two thoughts that certainly won't help you sleep better at night. But like I said, I think the word for the year is going to be uncertainty. And this is from John Williams, the San Francisco Fed president, but he said, uncertainty is having a depressing effect on spending and investment, completely agree, and has potentially added a full percentage point to the unemployment rate. And so until that uncertainty abates a little bit, gets better, we have a little bit more certainty, you're going to see a lot of consumers and a lot of businesses standing on the sidelines. And as Ben Bernanke and the Fed minutes continually say, the risks are definitely skewed to the downside. There's still significant downsides remain. All that said, we are certainly more optimistic about this year, and we'll be happy to answer more questions at the end.
Thank you, Brian, for being a little bit more upbeat. I guess you must have had a good Christmas, huh? So before I bring the next presenter up, another economist joke for you, just to keep the humor here. What's an acceptable level of unemployment? An acceptable level of unemployment means that the economist to whom it is acceptable still has a job. For the next presentation is on the regional real estate market, which clearly is of great interest and excitement to most folks here. That report is produced by Mark Ross and Sudhir Thakur. Mark is a real estate investment broker at CBRE Incorporated, specializing in the sale of multi-housing properties in Northern California and Northern Nevada. Mark graduated with his MBA in real estate and finance from the University of California, Davis in 2001, and has been a CFA charter holder since 2001. He received his BA in economics and business administration from Rhodes College in Memphis, Tennessee. Sudhir Thakur received his MA in economics and urban planning from Punjab University in 1996 and University of Akron in 1998, and a doctorate degree in economic geography from The Ohio State University in 2004. He is currently an associate professor in the College of Business at Sac State. His research interests on the areas of economic geography, development economics, technological change and regional development, and geospatial analysis and modeling. Please welcome Mark Ross.
Good afternoon. As Sanjay mentioned, my name is Mark Ross, and I've been in commercial real estate for 12 years, and at CBRE for 9. In fact, the picture on the screen there is from 9 years ago when I became an investment real estate broker. Back then I was single, I had no kids, and the market was on fire. Basically, I had hardly a care in the world. Well, flash forward to today, and I'm now married. I have 2 small children, and I lived through the Great Recession, which of course hit the real estate sector harder than most segments of the economy. So here's my updated picture. Hey, at least I'm smiling, right? Well, today I'm going to provide a quick overview of the residential and commercial real estate markets in the region, along with an outlook for each. Before I begin, I want to revisit a graph that we provided in our very first SBR publication 3 years ago. At that time, we pointed out that at the peak of the market in 2005, 26%, or roughly 1 out of every 4 jobs in the regions, were real estate related. And that 3 years later, that percentage had fallen to 22%, or just 1 out of every 5 jobs. In other words, although most sectors of the economy were shrinking, the real estate sector was losing jobs at a faster rate. Well, that trend has continued and even accelerated. And today, just 15% of jobs in the region are related to real estate. Clearly, the Great Recession had a disproportionately negative impact on our sector. But believe it or not, there are bright spots, more of them today, in fact, than a year ago, giving those of us who are left in the 15% a little more reason for optimism. Again, I'll just touch on a few highlights from each property sector and then provide a forecast. I thought I'd begin with the real estate market, since I suspect most people in this room will relate best to this sector. Unfortunately, this is not yet a bright spot. After stabilizing the past 2 years, the median home price for the Sacramento region has now fallen to its lowest point since 2002, a function of both the composition of sales and another year of value erosion. The price per square foot sold in the region fell about 6.5% last year, while the median home price dropped 10%. As you can see on the slide, REOs as a percentage of sales remain elevated, representing a little under half of all sales that occurred last year. In terms of new home sales, the number of sales failed to their lowest point since the early 90s, failing to reach 2,000 for the year. Looking forward, we see basically another moderately down year as the heightened level of delinquencies and foreclosures will continue to add downward pressure on values in the near term. Switching now to the commercial sectors, I provided a graph which shows the current vacancy rates by property type. As you can see, they're not all faring the same. For perspective, I should tell you that the natural equilibrium rate, or the rate at which the balance of power between landlords and tenants is in equilibrium, is slightly different for each. For the multi-housing sector, the equilibrium vacancy rate's around 6%. Anything above that rate, and you get softening rents. Anything above, and you get rent inflation. As you can see, vacancy in the multi-housing market is below its equilibrium rate. The equilibrium rates for the retail and industrial sectors are roughly the same in the 8 to 9% range, while the equilibrium rate in the office sector is roughly 12%, or half the current vacancy rate. Obviously, the office market is suffering the most. So let's start there. We experienced another year of negative net absorption in 2011, which is the change in occupied space from one period to the next. That means that the office market has now shrunk for 4 consecutive years, the first time we've seen this happen since our firm began tracking this data 20 years ago. This has caused the vacancy rate to climb to a record level, on track to possibly reach 25% this year. Consolidation, downsizing, and upgrading space at discount pricing were the main drivers of leasing activity. Many call this quote-unquote negative activity, since it's driven mostly by contraction in the market. We expect this type of negative activity to continue in 2012 and for lease rates to continue to soften due to, among other things, an increase in bank REO offerings. As new investors enter the picture with a lower cost basis, they're able to attract tenants with lower lease rates and still remain profitable. Okay, so here's where we begin to see some cause for optimism. I'm going to touch on the industrial and retail sectors together, since those markets in many ways have cycled together. In both cases, the data clearly shows these markets have bottomed and are showing signs of improvement. They both saw positive absorption last year, along with a modest fall in vacancy. Rents stabilized, and tenant activities increased. Also, there are some build-to-suit construction projects underway, and even a few land sales to end users that recently occurred that represent very positive market indicators for the industrial and retail sectors. One thing to keep an eye on, though, in 2012 and the years to come is the increasingly competitive grocery sector. We're seeing a huge influx of new grocery deals being made and several new grocers searching for the marketplace. Whole Foods, Sprouts, Sunflower, Fresh and Easy, and Walmart's grocery-only concept, to name a few. It'll be interesting to see if the market can support all these new grocers. Aside from that, we see the retail and industrial markets offering more of the same in 2012, meaning a slow but continued climb back to health. Tenants will continue to move up to better located and higher quality buildings, and national tenant activity will remain healthy as they have the resources to take advantage of what many are calling California on sale. I chose to wrap up with the multi-housing market, since this is undeniably the most lucent bright spot in all of real estate today. The rental market is thriving due to continued population growth, displacement from single-family homes, a fundamental shift in preference towards renting, and unlike the other property sectors, we didn't overbuild apartments. These factors caused the vacancy rate to fall and rents to rise last year, particularly at the higher quality properties. We expect that the rental fundamentals in the multi-housing sector will remain healthy in 2012, and that rent inflation at higher quality properties will ultimately create headroom for growth in rents in the lower quality segments. So in conclusion, we clearly still have a ways to go before we can characterize the regional real estate market as healthy. But just as I stand here today with a few more bright spots than a year ago, I do expect to return here next year with another slightly better outlook. Thank you.
Thank you, Mark. Zillow was telling me my house value went up 10% though. Our next economic report is on the health of the banking sector, and it's a banking forecast. It's produced by John Lederer and Anna Vygodina. John Lederer is the founder and president of Lederer Private Wealth Management, a Sacramento-based registered investment advisory firm. Jonathan graduated with his MBA from the University of Michigan's Ross School of Business and received his BA from the University of California at Berkeley. Jonathan has been a CFA charter holder since 2003 and is currently the CFA Society of Sacramento Vice President. Anna Vygodina is an associate professor of finance in the College of Business at Sacramento State. She holds a PhD degree in finance from University of Nebraska-Lincoln, an MBA with an economics minor from University of Nebraska at Omaha. Anna's research interests are in exchange rates, speculative tensions, and heterogeneous expectations in the capital markets. Please welcome Jonathan Lederer.
Well, thank you, everyone. Those that know me well are very aware that I'm a big trivia buff, and so I thought what I'd do to kind of keep everyone on their toes here in the audience is start off with a little local banking sector trivia. So what I'd like to know is, as ranked by total assets, as measured by total assets, can anyone name the largest bank based here in the 6-county region? And I'll give you a couple choices. First, Bank of Sacramento. B, Tri-Counties Bank, C, River City Bank, or D, Sanjay Varshney's Piggy Bank. Because we are not including offshore accounts held anonymously in the Cayman Islands, the answer is Tri-Counties Bank. They're based out of Chico. They have total assets as of September 30th of $2.5 billion. One of my other reasons for putting that question up there is just to give you an idea of the universe that we look at when we cover the local banking sector. We look at 18 banks based in the 6-county region with total deposits north of $50 million. And the reason we do that is because the bigger banks don't really break out their lending activities, geographically by metro area. So this gives us a pretty good feel and enables us to kind of focus in on what's happening locally. But as you can see here, I mean, Tri-Counties, they're the largest amongst that 18 banks we're talking about. And they're roughly 1/900th the size in terms of assets compared to B of A, as of September 30th, looking at total assets on the balance sheet. So you can just see how small we're talking about. The key points we're going to be talking about, we're going to talk about credit growth and its impact on the economy in a little bit more detail. Axel alluded to it during his presentation. We're going to talk about the same thing we talked about last year, is that the banks are going to have a tougher time growing their top line because loan demand is still pretty weak, and now the spreads, the differential between longer-term interest rates that banks lend out at and shorter-term rates that they pay out to depositors, that has compressed in recent months after the Fed's Operation Twist, which you may have read about. Problem loans are still elevated at the local bank level, but fortunately, many of the banks are in better position to work through that. And then finally, we continue to think that merger and acquisition activity amongst these local banks is a matter of when and not if. Private sector credit growth, and I apologize if this is a little bit tough to read, but I've put this chart together looking at every recession and recovery that we've had in the United States since World War II. And what you typically saw prior to the last recession that we had was you'd see growth decline, and then we'd come booming back out in recovery, and within a pretty short period of time, we had exceeded the prior peak in economic growth. Looking at a little over 2 years past when the recovery started, on average, GDP growth from the point of the bottom till a little over 2 years afterwards, GDP averaged 11%. One of the key things that drove that, in my opinion, was the role private sector credit growth played. I also tracked during that same period of time in every post-World War II recovery prior to the latest one, you can see that on average, private sector credit grew well north of 20%. So what had typically happened was, the economy had slowed down, people would take on more debt. You had what BCA research has termed this debt super cycle, whereas in 1950, you had total debt to GDP in the United States of 125%. At the time of the financial crisis, it was well in excess of 350%. People would just take on debt. It would help drive these strong recoveries. But this last recession and recovery has been different. As you can see, if you can see the very bottom of the charts, growth coming out of this, even though it was the most severe recession we've had since World War II, so a lot of people thought because it was so severe that the recovery would be robust, but it's actually been half of that average level. And one of the reasons for that, you can see the key differential in the lower right. If you look at the post-World War II average and then the most latest one, we've actually seen negative private sector credit growth. People have deleveraged. And that's not a huge surprise. I talked about this last year. There was that McKinsey study that came out in 2010 that studied the aftermath of financial crisis, and they saw very similar phenomenon. It was a 5 to 6 year period that people are cutting back debt. Because you think about it, most financial crises are caused by excessive debt levels. People are working through those, and it's a 5 to 6 year process. They actually came out a couple weeks ago with an update to that study, which I read Sunday, and I'll stop with offer one quick bit of advice. If your favorite NFL team blows the NFC Championship game, don't try to lift your spirits by reading through a 65-page paper on post-crisis deleveraging. It doesn't really do the trick. But what that update did do, I did read through it, and they're basically saying, McKinsey said, we're basically on track. And the reason I bring that up is because we talk about the banking sector. For banks to thrive, they need people taking on more loans so that their loan books are growing, not cutting back. And so that's why we've talked over the past couple years how the banking sector is going to be under pressure from growing those loan books. And you can see here, this slide shows our group of 18 banks over the past couple years, their aggregate loan books have declined over the past few years. We also showed all banks nationwide using FDIC data. You can see a little bit of disparity there. We would argue for two reasons, because the Sacramento region's been a little bit weaker in terms of our recovery, and so our loan growth has fallen more than it has nationwide. And then also, as I mentioned before, we're looking at a smaller universe of banks. Some of the bigger banks haven't seen as big of declines. But nonetheless, it's a big factor. And so one of the key questions this year is, are we going to see this trend reverse, and is loan growth going to pick up? We think it's going to be difficult for that to happen. And I apologize, this is another one of the all lines charts that Axel talked about. But this looks at demand for loans using Federal Reserve Senior Loan Officer survey data. And what this measures is it surveys these bank officers, says, are you seeing higher demand or lower demand for credit by different area? And you take that net number to see, are more people demanding credit or not. And so when the number's positive, as it was in the very left, shows that third quarter of 2005, when times were a lot better, that number was positive. Then, it got really ugly in, the depths of the recession. Last year, the numbers were slightly negative. It's encouraging to see in a lot of areas, they've actually turned positive on a nationwide level. And so that gives us a little bit of hope that maybe things are looking better, that you might see more demand for credit. Sanjay and Sung Bak, who's going to talk a little bit later, talking about SBA loan activity has picked up locally as well. So those things give us a little bit of encouragement, but unfortunately, when you talk to some local credit officers, they still say that demand is awfully weak for credit here in the Sacramento region. So we think that's going to be a challenge, for the banks, and also to really see solid growth economically. One of the other difficulties for the banks, this is looking at the differential, as I talked about before, between longer-term interest rates, that's a 7-year U.S. Treasury on the top, and then the bottom line is the 6-month U.S. Treasury. Banks, really like that when that spread is very wide. Because as I mentioned, they lend out at longer term rates, they pay out depositors shorter term rates. Those spread opportunities have compressed thanks to our friends at the Fed with Operation Twist. Right now, that spread's about 1.4%. As you can see, it averaged more than 100 basis points more than that during 2010. So this combination of challenges of growing the overall loan book and then coupled with the tighter spread opportunities is going to make it difficult for the banks to substantially grow the top line. At the same time, problem assets still elevated. This is an update of a chart I showed last year. Fortunately, the numbers have come down from where we were more than a year ago, but as you can see, relative to where we were before the recession started, I mean, they're still quite elevated. Banks have to work through these. Fortunately, they're in better shape to do so. If you look at capital levels over the past several years, that's the left-hand side of I guess it's the left-hand side from where you're looking at. They've gotten stronger on a weighted average basis. And then also loss provisions. Banks are much better reserved now. Whereas 2 years ago, for every dollar of non-performing loans, banks had set aside $1 in loss provisions. Now that number's up to $3 for every $1. So the banks are in better position to deal with these problem assets. So finally, this is looking at the aggregate income statement for the banks and all 18 banks as a whole. And last year we said it was going to be tough to grow the top line. Turns out we were exactly right. I mean, if you look at net interest income, it was literally 0.0%. We think it's going to be similar. It's going to be very challenging to grow that top line. The one thing that was very good that we underestimated a bit was the provisions for loan losses, what they set aside. Those levels came down. They were down 42% in 2011 versus 2010. And so as a result of that, if you look at the difference in net income year over year, it was actually quite strong. They grew it by 94%. Now, some of you who were here last year may say, you told us they were going to have a hard time growing both the top and bottom lines. And to that, I'll respond with one of my favorite lines from the Fletch sequel, which is, "It takes a big man to admit when he's wrong. I am not a big man." But I have to admit we did underestimate it a bit. That said, we still think the similar trend is going to apply. The top line is going to be tough. This year we may see those provisions come down a bit, but I don't expect to see such a huge year-over-year growth in net profits because you're coming off such a bigger base. We think the banks will be fortunate. They'll probably be able to get a little bit of profit growth, but it's still going to be hard. And because of those growth challenges, we continue to expect merger and acquisition activity amongst these smaller banks. We said the same thing last year. We thought it would happen by the end of 2011. Hasn't happened thus far, but we still think it's just a matter of time. And with that, I will conclude, and I'll look forward to your questions during the Q&A session.
Thank you, John. That was very insightful. Since both John and Axel talked about the Federal Reserve policy, why did God create economists such as those of the Federal Reserve? Why? In order to make weather forecasters look good. The next report is a report on the small business economy. It's co-written by myself and Sung Bak. Sung is an associate professor of entrepreneurship and strategic management in the College of Business at Sac State. He earned his PhD in business administration at the University of Tennessee at Knoxville and his MBA at the George Washington University in Washington, D.C. His expertise is in the area of new venture creation, small business management, entrepreneurial transitions, innovation, and corporate entrepreneurship, and global management and strategy. Please welcome Sung Bak.
I wish I had the Jonathan-like attitude and presentation skill, but guess not. Okay. I'm here to talk about sector of small business. About a year ago, we provide you some data and statistics telling you that the Sacramento region is SME-driven economy. SME represent a small and medium-sized enterprise. In line with that, this region SMEs hire more than half of total workforce in this region, and also SMEs produce at least 50% of regional economic output. So has a big role. So let's a little bit more about this SME today. Having this said, I'd like to show you this little complicated chart with you. This chart has telling us SMEs in this region outgrown all other sectors of economy. What that means, for instance, if you see the real per capita income for the last 10 years, it only has grown by 2%. But total number of employees hired by the SMEs in this region for the last 10 years has grown by 22%. In a nutshell, if I combine all these complicated indicators together, if you divide general economic indicator in this region, these guys have inverted V-shape in this chart. However, these SME indicator, the tails or head of this SME indicator has not been going down as years go. So, given that Sacramento is SME-driven economy, we have a healthy sign for the future. Next, I would like to talk about the small business financing. Okay. This chart is telling you about, like Jonathan pointed out, the total dollar amount of SBA loan approved during the last year. Compared to 2010, total dollar amount of SBA loan approved in this region has been doubled up. To be exact, 46%. This is tremendously positive news because lenders in this region, they loosen up once frozen small business financing. This chart doesn't have that, but when you look up total number of SBA loan approved in this region, the number didn't go up that much. That means average size of this SBA loan has gone up. This tells you about the two story. Yes, lenders loosen up their small business financing. At the same time, when they see good potential, they're aggressive and they're ready to go. This one tells us about the little bigger hope in this region. Next slide is about actually highlighting my presentation. As you know, the SBA created Small Business Confidence Index about 2 years ago. Every 6 months, we put it out, this survey out with the small businessmen in the region, and we measure this Small Business Confidence Index. The winter 2012 result has been in, and this chart tells you about the actual result. On this chart, I can find it out. I can tell you 3 different pieces of information. First one is kind of sad one. When you look on your left-hand side measures, pretty low. That means local SMEs do not have much optimism in region's economic outlook, still under the stress. But when you look up 2 right-hand side measures, which is happy side, the SMEs have confidence and optimistic about creating new jobs. And also they are optimistic in creating and producing new line of revenue in the future. Very positive. The third piece of information in the middle, which I call the exciting side, that when you see that in the middle measure, the confidence level of people, SMEs, about getting bank credit has been skyrocketed. That is a great sign. Actually, this piece of information is completely in line with, consistent to the SBA chart that I showed you a minute ago. Okay. That said, what is the takeaway? Out of this small business loan chart and also small business confidence index result, we are cautiously optimistic about SMEs new year, 2012. We don't know, though. I do not have a chart on here. When you dissect this small business competence index, sector by sector mean industry by industry. The SMEs in the manufacturing sector has extremely low competence level. That means they are very pessimistic about economic outlook and some others too. That actually is partially considered to the recent loss of jobs in the manufacturing sectors in the Sacramento. So that also tells us about what we need to do in the down the road. As a concluding remark, we are very certain and hopeful for this new coming year, and also our data actually support that. Having that said, we predict we have a better and more stable road, particularly in the area of SME in Sacramento. Thank you.
Thank you, Sung. And by the way, all these detailed reports are there online at www.sacbusinessreview.com. They are free, so you can download them anytime at your leisure. The last but not the least economic report for today is on the capital market and the local private sector in the region. It's produced by Jason Bell and Hao Lin. Jason Bell is a Senior Vice President and Senior Investment Manager for Wells Fargo Private Bank, where he manages funds for selected clients and leads the firm's domestic equity sector strategy team. He's a chartered financial analyst and holds a business degree from the University of the Pacific, as well as an MBA from the University of California at Davis. He currently serves as a senior volunteer leader at the CFA Institute, representing approximately 10,000 members in the Western United States. Hao Lin is an assistant professor of finance in the College of Business at Sac State. He has a PhD in finance and a master's in financial mathematics, both from the University of Warwick in England. His expertise is in the areas of financial markets and market microstructure. Hao holds the Chartered Financial Analyst designation and serves on the board of directors of the CFA Society of Sacramento. Please welcome Jason Bell.
Thanks, everybody. It's great to see a great crowd here again this year. And once again, I'm acutely aware that I am the last presentation standing between us and the bar. So we'll make this crisp, quick, and hopefully insightful. Today, I'm going to cover the macro forces at hand, very similar comments to Axel, and then also take a brief look at the stock, bond, and commodities markets. And then I'm pleased to reintroduce our SBR Financial Conditions Index, authored by Hao Lin, and summarizes the work of our team. There we go, that's working. Okay, John talked about banks. I think this graphic illustrates the challenge that are facing many of our financial institutions around not only the nation, but the world. And the first bold prediction of my presentation, which is guaranteed to be right, is the Mayans and Nostradamus were wrong. And if I'm wrong, then it won't matter. No one will be here to call me out on it next January. So in all seriousness, 2012 really looks to be one that's rife with political risk and policy risk. And what we mean by policy risk is there's a high potential for policy blunders. We hear headlines coming out from the Eurozone every day. And of course, last night we had the presidential address. We're in a presidential election cycle, which will have an unusually significant impact on the capital flows in the markets, from fear and greed, euphoria to dismay. The other macro force that we feel is strongly in hand is this continued deleveraging cycle. John touched on it on his presentation from the debt supercycle. The follow-on effects of an implosion of this is a multi-year deleveraging cycle. First, it starts with the consumers, and we've seen those numbers get better as consumers have rebuilt their savings and have paid down or walked away from debt in certain cases. We've seen this in the in the business sector, where corporations have been either paying down debt or refinancing at very, very low, attractive rates. We're now in the section where it's the government's turn, and we're seeing the government sector shrink its workforce and cutting back spending. And as many of us know, this has a particular impact for the Sacramento area, as the labor force in the government sector accounts for about 30% of the employed people in town. So this is something we're watching very carefully. Brian touched on it earlier, that we expect the unemployment rate to remain high, around 10–11%, and there is still a very large output gap. So the combination of the sustained unemployment and this deleveraging is keeping a lid on inflation, and in fact is very deflationary in nature, meaning it pushes down asset prices. This helps explain one reason why the monetary policy continues to be very loose, and policymakers are very sanguine about that. When we look at all things together from a macro backdrop, these combine to result in sluggish global growth, probably somewhere in the mid 3% from a global perspective, a little more than 2011, but well below trend. So let's turn to the stock markets. Stock returns were flat for 2011, and while we've enjoyed an unusually strong January, even today, we're still very, very cautious about the markets. When we started out looking at a forecast for the year, we thought, maybe about 6% on the year for the equity markets, measured by the S&P 500. That's the good news. The bad news is we've got about 4.5% of that as of January 25th, so we need to keep things, expectations tempered. Fundamentally, things look pretty good. Valuations are reasonable by many measures. Monetary policy is easy. It was communicated today. It's going to stay easy. Global growth is mediocre, decent. Balance sheets are strong, and earnings prospects are reasonably good. Technically, the picture's not so great. Investor complacency is very high. The volume of stocks that have been driving this rally in the markets since December continues to shrink. And stock prices are nearing what we call technical resistance levels. So this adds to our concern level. Axel spoke of it earlier today. Correlations between asset classes, meaning how asset prices move together, still remains very, very high. And the herd mentality is extremely prevalent in the markets. So while volatility is subdued now, we are quite certain it's going to return with much gusto. With that, we do expect a correction in the equity markets in the first half of the year. We could see levels that return to the October lows. Hopefully we don't get there. And this is based on the technical picture, as well as considerable chances of a policy disappointment stemming from the Eurozone crisis. Other catalysts include the many of the sovereign debt refinancings that are taking place in the Eurozone that are scheduled to take place basically from now through the next 3 to 4 months. We do expect a recovery in the latter half of the year and would favor U.S. and emerging markets over Europe. And from a sector perspective, we like energy and technology. Presuming the recovery is on track from a macro basis, financials do remain extremely undervalued. So let's move on to bonds. Bond prices continue their tremendous run last year, and all over the world, central banks continue their purchases to keep rates low and liquidity flowing. The Fed has committed openly to communicating their intentions and had their first press release today. And they have extended the term to where they're going to hold interest rates low from mid-2013 to late 2014. So another 3 years that we're going to see interest rates low. And for those that are counting, the 10-year today, 10-year Treasury yield is about 2%. The 5-year Treasury yield is about 0.8%. So that gives you a sense of what they mean by holding rates low. Now, when we look at the private sector, we're starting to see credit demand become a little bit more self-sustaining, and that's a positive sign. That's going to help support bond prices as well, and a good shot of general risk aversion will also keep rates low. However, despite the significant forces that are keeping bond prices high, we do expect some erosion as the economy continues to recover over the year. We could see, well, this was actually, I wrote this before Bernanke issued his report today. The 10-year may go up to as high as 3% by the end of the year, but I think we're going to have to ratchet that down a little bit. So, moral of the story, refinance now if you can. Rates are on sale, and after 2014, they should be going up. From an investment standpoint, we're sticking to our call that corporate bonds, municipal bonds, and high yield debt will outperform government bonds. There simply is not much more room for them to appreciate. Moving on to the commodity markets. Forecast is better year, not great. That's not too difficult of a call. Commodities got hammered last year as the emerging market demand cooled and the euro crisis caused a flight to the dollar. At this point, we think the corrective action looks nearly over and the commodity complex looks fairly attractive. Now, China is the key to this equation. Their inflation levels have become more manageable, which has allowed them to move towards a more accommodative policy stance in an effort to spur growth. Now, the ongoing saga of Europe will keep the relative price of dollars higher than normal, which will create a bit of a headwind on the commodity complex. And this is the primary reason why we're not more bullish on the space. Within the commodity complex, we favor oil as global demand is forecasted to rise. And additionally, escalating tensions in the Strait of Hormuz will keep oil's bid high. We also like precious metals as the massive amount of monetary stimulus is supportive for prices. Gold looks to have completed its correction and is favored this year. Now lastly, I'm happy to reintroduce our Sacramento Business Review Financial Conditions Index. This is a graphic that really sums up the collective work of our team, and we think captures a good indicator of the health of the region. We use 4 different factors when we have created this index, and we'll be tracking this going forward so we can measure together how we're doing as a region. So the areas that we bring into this calculation are 1, employment, and that's the change of total employment level in private and government sector. Real estate, we look at median home sale prices as well as the volume of home sales. We look at gross credit extension from the locally based banks in the region, in the surrounding 6 counties. And lastly, from a capital markets perspective, we look at the share price levels of the 10 largest local publicly traded employers. So it has a distinctly Sacramento flavor to this index. Our latest quarterly reading shows that while we're still below 2008 levels, but the recent data is somewhat encouraging. And though still struggling, the local economy appears to have bottomed out in early 2011 and is showing preliminary signs of stabilization. One thing we are watchful for is the government sector, as we spoke about earlier. And those employment levels are still declining, so that's something that could have an adverse impact on the index and more importantly on the economy. And we'll keep an eye on that in the future. So with that, I'm going to wrap up my comments and turn it back over to Sanjay. Thank you.
Thank you, Jason. As I said earlier, today we just released the headlines. In the agenda, you can see the bullets. But really, if you wanted the more thoughtful and insightful analysis on each of the different reports, you can go online and download the detailed reports, which I really thank my team for because they do a phenomenal job, producing those reports. So may I have a warm round of applause for our team here. Now comes the fun part. Given that we have given you the headlines for the coming year, you get to ask questions. Okay, I'm sure you have, questions that cross your mind about the region or the nation or the world economy for that matter. And we have the experts here. So we have a Q&A session right now. We have at least 2 microphones that are available going around the room. So please, this is now an open session. Questions?
Thank you, Sanjay. Yeah. 2012 will undoubtedly, one of the headlines in this region will be the funding or non-funding of the arena. And I would like to get the panel's opinion. We have heard plenty from talk show hosts and local newspapers, but little from the economists here on what the potential upside or downside of an arena deal is, and how might it compare to the airport deal, which was much more in scope and size and has already been executed.
Anybody want to take it? Nobody wants to take it?
I'll take a shot at it.
Okay, all right, go ahead. John.
I'm a passionate Sacramento Kings fan, so my answer may be a little biased, but I do think objectively If we fail to get that done, I think it's going to be an overall net negative because, one of the things that we lack here is a diversified base of business. And, clearly one of the things that will attract businesses to the region is having access to professional sports. And if we don't have that here, I fear that, there's already a lot of constraints we have trying to attract businesses here to begin with, and if we don't have that arena done, I just fear it's going to get a lot worse. So I'm really hoping that it can get done.
I think from an economic impact standpoint, it would be a huge boost to the region, and a huge shot in the arm because, I've made these comments publicly before, and I make them again. Sacramento does not do a very good job marketing itself, and we don't have the notoriety that we sometimes think we have. And so to have a major franchise here does allow us to have some notoriety. And then, of course, it's a quality of life issue. If you're talking about wanting to attract people to move here or businesses to move here, we got to offer them something attractive as a city. And so in that regard, I think it's going to be a very positive thing. Yeah.
Yeah, maybe the only thing I'd add there is projects like that tend to have a very multiplier effect, and retail and leisure, specifically in Sacramento, is very sensitive to consumer sentiment. And anything that potentially increases that, gets the ball rolling, again, it could snowball and have more widespread effects.
Yes, go ahead.
The Greek debt. And my question for you, you mentioned that the Greek debt was pretty much a foregone conclusion. And my question for you is, if so, if the Greeks fail on their debt, what will be the consequences for us, and how should we adjust our portfolios?
Sure, that question on a Greek debt failure. Well, 18 months ago, there was the first time the talk came up of a Greek default, and people said the world would come to an end. The euro dived down to 118 or so. Well, half a year ago, the euro was at 140. It came all the way back up. And what we argued at the time, well, wait a second, this is mostly a Greek problem, it's a local problem, and it should be expressed in the bond market more than in the currency. But of course, everybody's concerned about the contagion, and who is next? Portugal is now paying 15, 70%, 17% on fairly short-term debt of just a couple of years. Now, the issue is, of course, what happens to the banking system. And there, the emphasis has to be in Europe, in our view, that the banking system must be able to stomach the sovereign defaults, because there isn't simply enough money around to save all the sovereigns. And that's what these facilities of the ECB, of the European Central Bank, are all about. And we know from 2008 in the US, from the 90s in Japan, we know that central banks can keep even an insolvent banking system afloat. And the ECB has made it very clear. They have said as much, that they'll do all it takes. Now, some people have misinterpreted it and saying, hey, they'll bail out the governments. No, they'll do all it takes to ensure financial stability, meaning they'll print as much money as needed to make sure the banking system will be fine. And so the places where we have our money, all these institutions are, quote unquote, too big to fail. So quite likely, nothing is going to happen. Personally, I try to stay away from institutions that have much exposure to Greece, but it's kind of difficult because everything is intertwined. So what we think is going to happen is everybody is going to print a lot of money because they're concerned about this contagion. Greece itself, people can absorb Greece. The question is, of course, what happens next and next and next. And in order to get ahead of the market, the policymakers need to come up with leadership and strong policies. And we just have this very dysfunctional process in Europe, how these policymakers are acting. And so what happens in practice is that the bond market is dictating terms. And so whenever we're in a crisis, we make some progress. And then the crisis abates, and we forget about the promises. And so that's going to be this very back and forth process. On the benign side, the glass is half full, half empty. We'll get through this, but it's going to be a very rocky ride. In the meantime, policymakers will be printing a great deal of money, and we'll see that in a debasement of currencies in general, favoring precious metals. And also, we'll see this correlation of assets. Because we have this active policymaker engagement, we'll have the next intervention to make sure the system doesn't fall apart. And so no matter what you invest in, it's going to move exactly the same way as everything else is doing. We have to have our preferences that you want to be where precious metals are, for example, New Zealand dollar, Australian dollar, and so forth. But we don't think the euro is going to fall apart. And also the banks are not going to fall apart. The central banks are going to make sure of that.
So on that note, Axel, if you had to speculate, this is a question that comes up quite often, and I want to take your take compared to what we think locally in Sacramento. If there is a Europe crisis, what's the spillover into, let's say, a local region like Sacramento?
Well, all these spillovers are also bigger than forecast, and that's one area where economists are terrible. Think about all this talk about the crisis is contained talk we've heard in 2007, 2008, in the midst of the crisis. Conversely, by the way, when we had the Lehman issue and so forth in the US, well, Trichet, the head of the European Central Bank at the time, gave some mathematical formula as to the spillover effect. The difference to 2008, though, is we know the playbook of the central banks. We do not have investment banks anymore. Everybody has converted to a commercial banking charter, which means everybody has access to the liquidity of the central banks. And so that's why these dynamics will be different. But as far as the real economy is concerned, by all means, Europe is a major, major partner of the US and also of the local economy. I don't have the Sacramento numbers here, but it's hugely important. And so it's hugely important to everybody. And by the way, a few weeks ago, we had this coordinated central bank intervention to provide US dollar funding to central banks around the world. To show you some of these interrelationships, Asia's funding comes from European banks in US dollar. And so that's where you see that these links happen. And then the banks of European banks came from US money market funds because they are yield chasers like everybody else. So they gave, when you had your favorite money market fund, if it wasn't a US government fund or some tax-exempt fund, odds are it had Societe Generale commercial paper in it. And so that's how you have all these relationships. That's the shadow banking system. And so these links are there. They're very serious. And that is why everybody's so spooked. And by the way, those swap lines, currently, and the Federal Reserve publishes that every week, it's at about $100 billion. Well, at the central bank level, we're just giving $100 billion to Europe. That's fiscal policy. Congress wouldn't, just in a phone call, give $100 billion over to Europe. And so if you want to make political drama out of it, as this crisis increases, the central banks will help. But sure enough, Bernanke is going to be called to Congress to testify, to explain all these things. And all of that is going to create tensions in the markets.
Okay. Thank you. Other questions?
Hi, I'd be interested to get any of your thoughts on the proposed high-speed rail project and what the potential impact could be to our region if the project goes through and if it does not go through.
Any takers? Okay, I can start with my comments. In general, any spending activity is going to generate economic impact, right? So you spend $100 billion on something, well, somebody's going to benefit from the $100 billion of spending. There'll be some economic impact. The question is, how is it getting paid for? Who's paying for it, right? And whether there's a major redistribution of wealth or economic impact, or is this new incremental economic impact that's being generated because of the spending? So when you ask that question, you can easily make a compelling argument that, while on the surface looks like a great idea, the question is at the end, how is it going to be financed or how is it going to be paid for, right? I was hoping for some controversy here. Like the political debates we see on television, right?
The issue, if I just can chime in here from macro level, is precisely that. We all love to have our benefits, but we don't have access to the financing, and that's with many of these projects. And it always works until it doesn't anymore. Right now, on the federal level, we can get away with spending a lot of money because the Federal Reserve keeps interest rates so low. Well, Greece doesn't get away with it. I'm not suggesting we're going to be in Greece's situation, but at some point that cost of borrowing is going to go up, and if we had to pay a couple percentage points more in interest, it would be very, very different. And so we are dependent on the Federal Reserve helping us to finance all these projects.
Right. I think it's also a scope issue, at least in my opinion. You look at Europe, for example, and a lot of my friends from Europe keep pointing out how the public transportation system in the United States does not even come close to what you see in Europe. But on the flip side, we are 3,000 miles wide as a country. And certainly when you look at, countries in Europe which are much smaller, when you put in public transportation, you got to keep the size in mind as to what is going to be the infrastructure investment as a sum. So any other questions? I saw some other hands right here.
Yeah, hi. Sanjay, over the last couple of years, the United States has been increasing exports quite well, and the president just stated that he promised doubling exports over 5 years, and he believes he's on target. You just forecasted that Europe's going to go into a recession, most probably, that there's a potential bubble in China. We all know about the earthquake in Japan, security issues in Mexico. What do you believe is going to happen to export growth? Will it continue to grow? Will it stagnate? Or will it go down?
Want to take that, Axel?
Well, everybody is trying to grow through exports. That's how you fill the kind of the gap and hole in your budget forecast. The problem is every country in the world tries to do the same thing, and you try to do it with currency devaluation. And so when everybody tries to do it, it doesn't exactly work as well anymore. And it's causing all kinds of unintended consequences. So those make for very nice political headlines. In practice, good luck. But conversely, of course, then you have to put in place policies that promote exports. And in the current environment in Congress, I don't see many things be put in place. On top of that, the sort of things that might be on the table, I don't think are the ones that are going to promote exports.
Other questions? There's one hand right up there, and there's one right there.
Hello. I had a question regarding the energy market. It wasn't mentioned today about green energy, and a lot of analysts have said like green energy is the new gold to helping us out of the recession. So what is Sacramento, or do you have any idea of what's going on with the energy market in terms of green energy?
I wrote about that a couple years ago before we started covering banking exclusively, but several years ago when there was a big buzz about green energy, the biggest thing with that continues to be the competitiveness of it relative to fossil fuel prices. I mean, we had the government that was subsidizing a lot of these areas, but it still hasn't completely picked up. I know we had our keynote last year was fairly optimistic long term that it can happen, but I think in difficult economic environment, until alternative sources become more competitive, I think you're not going to see a huge, I don't think you're going to see a takeover. And now you're seeing with natural gas, I mean, those prices are hitting very low levels. So I'm just not overly optimistic that it's going to be the savior that's going to get us out, that green energy sector.
Brian, I saw you had some comments.
Yeah, I mean, completely agree with Jonathan. I mean, no doubt it's one of the faster growing sectors. It just is still a very small portion of the Sacramento economy, our local economy. And like Jonathan said, it's a matter of competitiveness and how competitive can we be, maybe in the sub-segment of that sector. But we're still, I think, trying to find our identity there. And not to mention every other city in the U.S. is kind of touting green energy as well. You know, so it's a challenging environment for sure.
Well, I can chime in one more kind of comment on a general note. We are in an environment, I mentioned it a couple of times now, with this very active engagement of policymakers. That also applies to green energy. It applies to high-speed rail. The reason why I think in these economic forecasts you heard about credit growth in general is because that's how you're supposed to look at the markets. Because when you grow credit, the credit flows, the money flows to where it's best used in the economy. The more policymakers interfere and say, hey, it's green energy, it's high-speed rail, it's this or that will benefit the most, the more you're pretty much asking for capital misallocation. And some of these things are not a big issue. I mean, of course, the role of politics is to kind of steer the money a little bit, but you've got to be careful in not doing too much micromanagement in an economy so that over time, the capital that you invest actually is invested in the right place.
In general, I think on a global and a national level, you'll find that the alternative fuels and the biotech industries are two industries where there are major investments going in. And I think last year's keynote speaker had some wonderful data that showed how Sacramento compared, for example, to the Bay Area and some of the other cities where major investments were going into the green energy sector. And I think one thing is clear, that any high-risk taking venture requires a high-risk tolerance, and money basically follows high-risk tolerance. So I'm not sure Sacramento is got that risk tolerance compared to what you see in the Bay Area to be able to attract that kind of monetary capital, because monetary capital looks for very high returns. And I don't think we have that, because this is still a government town, and we have a very low risk tolerance in general in Sacramento. So, other questions? Yeah.
Hi, Sanjay. I wanted to throw out a little of that controversy you were asking about earlier. I was struck by the comparison between the question regarding the arena and the question regarding the high-speed rail. And although from a dollar perspective they are different in terms of scope, you seemed to end on two different sides when, to me, they're very similar in terms of trying to stimulate the economy in different ways. And I was wondering if the panel could just speak to the differences between the two, why you'd land on yes on the arena but no on high-speed rail.
Sure. Anybody wants to take a shot at this?
I thought the question was for you, Sanjay.
Oh, for me? Okay, no
Hung out to
worries.
dry.
No worries. I'll give you my perspective on that one. Okay. The arena project is also, the value of the arena project is also dependent on how it's going to be financed. We already have a huge controversy on the table right now. This conversation is not new. You know, I've been here for 8 years now, and for 8 years I have actually heard the conversation on the new arena. So clearly the bottom line, or you know, at the end of the conversation, the big multi-million-dollar question that shows up is who's going to pay for it? Okay, how's it going to be financed? And generally, if it's financed using private resources, the economic impact would look very different compared to when you're simply redistributing the economic impact from somewhere else in the city or the region into one specific initiative that you find that to be your favorite, right? So at this point, it is still a multi-million-dollar question as to how is this arena project going to be financed. And the more I see private on the table, the more encouraged I feel about its economic impact. We haven't reached there yet. The point I was making was that the notoriety itself has a very high value attached to it, which we don't sometimes pay attention to. My point is, we have already been struggling as a regional economy for the last 4 or 5 years now. We have been much badly hit, much worse compared to the rest of California and many other parts of the country. That's not what I expected from a large, vibrant economy like Sacramento. The question is, if you do not diversify the economic mix here and diversify the job base and diversify the industry mix, we can keep sinking in the future. So the question is, right now, the per capita income in Sacramento is lower than the statewide average. Well, how can you get there? There's only one way you can get there. We have many more jobs that are very low paid, and then we have very few jobs that are in the medium to high income brackets. Now, if we keep creating more jobs, the question is, what kind of jobs? Are these jobs at Home Depot paying minimum wage? Or are these jobs at Intel paying you a good dollar, right? I mean, that's the thing that we have to think about. And from that perspective, if I'm a company that's not in Sacramento right now, or if I'm a family living in some other part of the country, and Sacramento is saying, come to us because we are the best. And every community in the United States is doing exactly the same right now. The ones who have been more economically hurt, they actually are much more aggressive in marketing themselves. They're saying, come to us. Come do business with us, right? Whether you're Asheville, North Carolina, or you're Texas, Austin, every community is screaming, saying, please come move to Asheville, North Carolina, or come, you know, we'll give you all kinds of breaks or make it attractive for you to move. So in that sense, Sacramento needs more notoriety, and that's where the kinks come in. So I think the value attached to the arena project is going to be immense if they do it right, and it'll give us a lot more notoriety that we need. The high-speed rail project is a huge, I mean, that's a much larger project in terms of size and scope. So I think that project, once again, the question is going to be, how do you finance it? And is it going to be incremental economic impact, or is it going to be simply a redistribution of economic impact from someplace else? Who's paying for it? So,
Sanjay, I'll help you out here a little bit. Just from an additional perspective on that, if you look at an arena deal, and Brian spoke about the multiplier effect of the new businesses that are attracted, the capital that is spent, the tax revenues that are generated from the consumer spending, that can be a net positive to the Sacramento region. If you look at a high-speed rail project, that's a much more dispersed benefit across the state. And you have to ask the question of, well, what benefit comes back into Sacramento? Does that help us attract business? Does that help us attract new sources of revenue to our region? I don't know the question, but I think one of maybe the unintended consequences is it makes our labor force more mobile to take jobs in other places, and that might actually have a negative effect on the Sacramento region. So.
But one thing is true. I think if there was a high-speed rail right now between here and the Bay Area, our economy would change dramatically, because it would change it would shift the demographics here based on who's going to live here and where are they going to work. That's going to change. Yeah.
Actually, to just chime in on that, our office is Palo Alto, Mountain View, and we have all our young folks love living in San Francisco and commuting out. Now, we happen to work East Coast hours, so they beat the commute in both directions. But if they could live in San Francisco and work in Sacramento, I'm sure you'll attract lots of young, hip people. So this works both ways.
Yeah.
But ultimately, who's going to pay for it, I think, is the overwhelming question.
More questions? One last question? Okay, we have time for one more question.
Not a lot of information on the agricultural industry of Sacramento and how that plays kind of to our advantage and has been the bright spot over the last few years, as well as the global commodities moving forward and where we're exporting those. So I'm wondering what the panel's thoughts are on that.
Maybe I'll start with that. So farm and ag, as a percentage of the labor market, is still relatively small. As a percentage of output, it's actually, for its size, disproportionately large. We've actually talked about this very topic as a team, and actually with the mayor as well, because we do view this as potentially a competitive advantage for Sacramento versus other communities. Just, having UC Davis, the ag community, and the presence being here in the Central Valley. So, definitely view it as a potential that can be tapped. As of right now, it's still a relatively small, part of the economy.
Yeah, I'd like to see more emphasis. I talked about this at an event I spoke at last year. I mean, one of the advantages, as Brian alluded to, we've got a huge diversified base of agriculture, and we're a direct water route to Asia, who many of the big countries, it's a huge population center, are starting to import ever more, and I feel like we need to leverage that more than we already are.
And just to add to the discussion, this is something we have really had a lot of conversation about. Last year I was in Omaha, Nebraska for a meeting, and I can tell you I was blown away. It's in the middle of nowhere, but they have 5 Fortune 500 companies headquartered right there in Omaha, Nebraska, because they are at the center of agriculture and the transportation. They are the transportation hub for that part of the country. So it's something that Sacramento can easily beat, because we have much better access, actually, to the Pacific Rim nations, especially when you talk about import-export. So. Okay. I would like to thank the staff because they always help put on a great show. The media services, public affairs for helping us with all the media. CFA Society of Sacramento, catering, design, print. All those people make this program a big success. I would like to once again thank SMUD, Wells Fargo, CBRE, the CFA Society of Sacramento and Sacramento State for helping with the financial and the in-kind aspect of being able to host this. So as you can tell, ladies and gentlemen, this is a great show. Thank you for your support. Thank you for coming every year to listen to our forecast. Once again, you can go online, www.sacbusinessreview.com. You can download the whole thing. And we do have hard copies for each one of you before you leave. So we do have a complete, comprehensive hard copy in case you were not just planning to read it online. And once again, there's a hosted bar and lots of refreshments, completely complimentary for your enjoyment. So thank you very much again for coming in.